Hi everyone, well today I wanted to discuss something that's pretty interesting in the news. Now, what most of you may not know is I actually do a lot of private investing myself, and therefore the story about GameStop has been of quite a lot of interest to me this last week. For those who don't know, GameStop is a traditional offline bricks and mortar gaming retailer in the United States, and recently has created somewhat of a stir. It's actually a loss-making company, not doing so well, and historically maybe last year was trading just for a few dollars a share. Recently though, I think at the last close it was over around $350 per share. It's gone up hundreds of percent in the last few days. And why is it interesting? Well, it turns out that the price movement has been caused by a group of individual investors on Reddit that bid the price up, and at the same time they've cost hedge funds billions of dollars who are short selling the stock. So what I wanted to do today was explain what's going on and what I think is going to happen in the future. So firstly, let's discuss the situation in more detail. To understand what's happening here, you first have to understand what the concept of short selling is. For those who don't know, short selling is where an investor would borrow a stock from a broker and then sell that stock in the market. So it's selling stuff they do not own. Then, all going well, the price will go down, they'll buy the stock back at a cheaper price, return it to the broker and make a profit. That's short selling. And for many of the old economy bricks and mortar retail stocks or cinemas and so on that are all suffering over the last few years, a lot of hedge funds and institutional investors have taken large short positions, betting that those stocks will go down. Now, what happened in this case is, as I said, individual investors tried to bid up the price in a concerted effort. In other words, they all bought the shares. That caused something called a short squeeze. What's a short squeeze? Well, what happens in a short squeeze is that as the price rises and rises, the people who are short the stock, who are betting the price goes down, their paper losses become larger and larger. At some point, they close their positions. How do you close a short position? You have to buy the stock back. So to close a short position actually increases the buying pressure on the market, causing the stock to rise further, causing more short sellers to have too big a loss and therefore have to buy their stock back, creating that kind of self-reinforcing loop that bids the price right up. That's what happens in GameStop's case. As the hedge funds closed their huge short positions, price rocketed up even further. Then more individual investors saw that momentum, bought more of the stock, and it just bid up in a kind of a bubble. You may be asking then, why is it that the hedge funds didn't just wait it out? After all, this is clearly a stock that's not worth $350 a share. Well, the reason for that is that to be short, you have to post something called margin. Because you're borrowing stock from a broker, in return, you have to put a deposit of some money as collateral to show that you'll make good on your debt. As the volatility goes up and as your losses become higher, the amount of collateral you have to post to your broker also becomes greater. And at some point, the funds, institutional investors run out of money, can't post the collateral, and are forced to close their positions. And that is called the short squeeze, and it's what's happened in this case. So, what's going to happen in the future? Well, there are a few things to note. First, a lot of the individual investors have very high paper profits. The guys who got in at $10 a share and started bidding it up now sit on perhaps hundreds of thousands, even millions of dollars of profit. But because the main individual trading platforms have now closed business on these stocks, when this share comes eventually down, many of them may still make a loss or at least give up much of their paper profits. Platforms like Robinhood, which is one of the main platforms that individual investors have used to bid on this stock, have now said that they will no longer take orders on GameStop. Why is that? Well, brokers themselves have to post money or have to hold a certain amount of capital for their own financial liquidity. And again, the more the volatility is, the greater that amount of capital they have to hold becomes. In GameStop's case, this share is seesawing, sometimes 70–60% price fluctuations in a single day. It's huge, and therefore even the brokers are having to hold a lot of money to cover potential losses against the stock. At some point they don't have enough money, so they just have to say you can no longer trade. So what's happened now is there's very little liquidity in this market, which means that a lot of individual investors won't be able to close their positions and bank their profits. The second consequence is, well, to be honest, there has been some form of market manipulation here. Market manipulation is actually an illegal activity. It's defined as a situation where you tell people which way you're going to trade on the stock and encourage other people to do the same simply for the purpose of moving the price. In other words, there's no fundamental reason for doing it. But that's historically been very, very difficult to prove, and I'd be surprised in this case if the SEC in this case brought any particular prosecutions. But strictly speaking, by the letter of the law, I'm pretty sure there's been some illegal behavior there. Third, a lot of people have been very pleased about hedge funds losing billions of dollars But this isn't just a story of individuals beating hedge funds. First, lots of hedge funds and institutional investors were long the stock, betting it will go up. They've made hundreds of millions of dollars. In addition, some of the funds that have lost money have had to sell shares in other areas of the market, which is thought to be one of the reasons why the stock market has slid over the last few days. So whilst it may seem like a great story of the little guys beating the big guys, a lot of big guys have still won, and a lot of little guys have still lost. Finally, what do we look like for the future? Well, will there be more regulation on short selling? Perhaps. It's always been a very controversial area of the market because a lot of people have equated it to gambling. In addition, they don't think that real economy jobs should be subjected to the huge volatility that sometimes can come from short selling and short squeezes. At the end of the day, we have to remember people working at GameStop are real people with real lives and real jobs. It isn't just a casino gambling. It's genuine lives are at stake here. Finally, there is possibly some implication for other stocks with what's known as high short interest, in other words, a high number of open short positions. For many old economy stocks, a lot of people are betting that the Reddit groups and individual investors will try and do the same thing again. Identify stocks with large amounts of short interest from institutional investors, try and bid that stock price up, and replicate the GameStop story in other areas of the market. Clearly, if this keeps on happening, maybe something regulators will want to look into in future. And what does it mean for us as personal investors? Well, I personally have never taken a short position in my life, precisely because of this reason. As a short seller, your losses are theoretically infinite. A stock can go up forever. If you're long, or you're a buyer, it can only go down the amount at which it gets to zero, right? So as a short seller, you're exposing yourself to a tremendous asymmetrical downside risk, and that's what stung many of the hedge funds in this case.